Alrighty, cool. Alrighty, so our big thing, I think most of you guys already know this, but our big thing is backyard apartments. Of course, our company we called The Next Wave. It is both because it's an homage to the next wave while we're surfing, but also the next wave in San Diego housing, the next wave of ADUs and backyard builds.
Yeah, and absolutely. Of course, disclaimer, we are not CPAs and we're not lawyers. And anything that we present here is certainly not presented as a promise. And, anytime you have any questions, consult a professional CPA, a lawyer. Certainly, we have targeted returns, but nothing that is guaranteed.
So what we'll discuss today are jobs and investment portfolio, why we love backyard apartments, the opportunity we have right now that we're in escrow on this property here on Tennyson Street, which is in Point Loma, and how we are mitigating risk, how we're getting around, mitigating risks, how we're the exit strategy, and then also, of course, how to sign up.
Yeah, and I'll talk a little about myself. My name is Marcelo Valdez. I have had several careers and some different career twists and turns. Started off in the military, graduated from the Naval Academy, went into the Marine Corps, spent about 6 years there, active duty and reserves. I went to graduate school. I did a dual degree program with University of San Diego, MIB program, Masters of International Business, and also the MIT of Mexico. They call it MIT, but the Monterey Institute of Technology. Got out, worked at Qualcomm for quite a few years, did several expat assignments, one in Brazil where I met my wife, and one in the UK when we did an acquisition over there, and came back, spent several years back here. And then, of course, tech companies, we're seeing that a lot now. At that time was happening as well. They go through expansions and contractions, and I was laid off. And in a way, it was really a blessing in disguise because I had always wanted to go on to my next stage of my career, which is in real estate. And so that's what I've been doing now for about the last 10 years. And where then I met Andrew, and we joined up recently.
Yeah, and I'm Andrew Erickson. I'm a big data nerd, data analyst, expert. I have a degree in applied mathematics and electrical engineering. I am a spreadsheet wizard, as some people say, in automation. So I have a big tech background. I used to work at Qualcomm as a process test engineer and worked for a couple of different tech companies earlier in my career. And then I struck out to be an entrepreneur. And so I started a couple of different businesses, and we had a seven-figure exit on one of our businesses a few years ago, and I started a few more. So I put, of course, some of that into real estate. And I just love real estate, love all the things you can do with it and all the possibilities there are there with it. Like Marcelo said, we partnered up last year and realized that we could do that 1 + 1 = 3 with this thing, and we could really make a big wave here in the San Diego area if we can partner up. And so that's me.
Yeah, a wave or a splash. I'm trying to think about how many other things we could do to go with that theme. But yeah, so about the Next Wave Group. So now there's been several iterations. I formed again. The name goes back over 10 years, but I had started with a couple of different JV partnerships with projects that are now all basically done or very nearly done. Decided to form up an actual fund that I could run, and ran into Andrew, and it turned out that we decided that again, as Andrew said, 1 + 1 = 3. We really complemented each other. So we said, hey, let's go off and really tackle this housing crisis that we have in San Diego, and building what we call backyard apartments through incentives using accessory dwelling units. So we really like to try as much as possible to handle the life cycle through acquisition, underwriting, construction, before that, the planning, development, all of that, and really set it up so that it scales nicely and quickly. One of the things we'll show, looking to actually do our builds in 6 months or less. So really, yeah, working to make this something where as somebody who's an investor I know said that two is the new five. So with multifamily, typically people would say, we're going to hold your money for 5, 7, or 10 years. And our goal with the Next Wave Group is to be able to return investors money in under 2 years. So right now, our vision is certainly to grow even more past 2025, but in 2025, we have 24, the ability or the process of getting 24 units, additional units, in either a phase of construction, planning, development, wherever, acquisition, and to get to 100 by the end of this year, and to raise $10 million over the course of that year in order to do that. And again, as we'd said, just really making an impact by going out and getting affordable housing, and that is a key as well. The way we were able to do this is through incentives by making a portion of these units actually deed restricted affordable housing.
Yeah, so one big thing here of I'm going to talk quickly about why real estate's a good investment. I think most everyone's kind of understands that, but it is good to talk about it a little bit here. And the jobs of an investment portfolio, of course, is to protect against inflation, long-term growth, and also reduce the risk through diversity. Right. And so here's this interesting thing that came from Tiger 21, which is a mastermind for rich people, basically. They ask people what their portfolios look like, and these are mostly business owners, so they have very high in private equity, which is usually their own personal businesses, right? But also a huge chunk in real estate, and a big chunk in stocks, of course. So it's always a big healthy part of a portfolio. And of course, why would you want to invest? The best thing to do for real estate, though, is invest passively rather than buying your own unit and trying to, fix it up and do it yourself. Is just to do it passively. And the nice thing there is that you can get actually better returns and have no tenants, toilets, or trash.
Yeah, and to when you're doing so, you're leveraging somebody else's experience, and I've dealt with many tenants and toilets and trash. So, okay, so our investment strategy. So backyard apartments, as we have here, we say, equals ADU. So as you may know, California has an accessory dwelling unit law that applies throughout the entire state of California, where you can build one ADU up to 1,200 square feet and a junior ADU. And this is something that's by right throughout the entire state. So, but what the city of San Diego did is that we're going to take that and we're going to, because we have this big challenge of building, of being able to get enough housing into the market. So they said, we'll allow you to take in either a single family zone or a multifamily zone, and using the incentives that say that if you build a certain amount of deed restricted units, will allow you essentially to max out the floor area ratio with also additional market rate units. So right here is an example of single family home where we started off with, of course, single family home on a larger lot and added 6 units in the back. And the way we did it is they all fit within both the state and the city's accessory dwelling unit law, and they're all just a series of duplexes. So one unit on top of another, we put them together so it kind of looks like one solid multifamily unit, and we're able to build very quickly that way. And we'll actually show you what it looks like because we're pretty much done now.
Yeah, and one thing I want to gush a little bit on Marcelo is he's kind of pioneered this technique of the way he designs these things. These are technically townhouses, like legally they're townhouses, and so the regulations and the code enforcement is much easier. There's fewer things to enforce, fewer whatever. So they're actually coded, or the residential code is all residential rather than commercial. And so you can't tell because it all looks like one building, but there's actually a giant firewall in between these, and that just makes the construction, the speed, and the ability to get the permits done much faster, and therefore subsequently cheaper. And so it's pretty cool. Now picture this in your mind here. this drawing because we have a really cool drone shot of it in a few minutes.
Yeah, another quick thing too is that by doing this, so like actually very close to where I live, somebody did something very similar. They have 8 units, and it was in a multifamily zone, so they're able to be a little bit more dense. But because of the fire separation, and that's why we do this, uh, they separated the townhomes. You have, as you can see here, they're kind of together, right? You have two next to two and a next to two. Well, they separated them so that there is more than 6 foot separation, and which looks fine, but it also means that the units themselves, because of setbacks, are smaller. So the difference between, let's say, a 450 square foot or 500 square foot unit and a 400 square foot 1 bedroom, 1 bath is tremendous. As soon as you walk in, they just feel that much smaller. So a 10 or 15% reduction in size makes a really big difference. So this allows us also to make the units a little bit larger within that footprint.
Yep. Now, why do we like backyard apartments? Well, Marcel already touched on that component there. The big thing here, of course, really good returns. We're talking 20%. Marcelo doesn't like me promising anything more than that, but my spreadsheets are predicting substantially more than 20%, but we're just saying it's likely 20, well, it will be more than 20%. We can get into the actual numbers later at the end here. I also have a spreadsheet we can run through if we have time. Also, the thing is that the short timelines. The city is prioritizing getting these things permitted ASAP, and so the timelines, to permit are less than a year, and to build is less than a year. So it takes 1 to 2 years to get everything done. You're just wham bam, thank you, ma'am, with the project. Also, the social good. I mean, we're building affordable housing. This isn't luxury housing for super rich people to just be more rich, right? These are working class people, nurses, doctors, not well, nurses, police officers, teachers, just everyday working people. Of course, there's a high demand. I mean, San Diego, I don't really have to describe to you guys the demand in San Diego, right? But people want this kind of housing. There's this thing I'm calling an arbitrage opportunity because what we're doing is we're buying single family homes on single family home comps, right? But then we're turning them into commercial properties. And so then we can buy on a comp based model and sell on an NOI based model, which is like a commercial property. And so the of course we're looking for those opportunities where the comps are relatively low and the NOI returns are relatively high. And also the nice thing here is that the mayor was just reelected on the campaign or on the platform of building affordable housing. That is his helping the homeless, building affordable housing. Those are two of four of his top platform things. And there's a little bit of hubbub that the city was thinking of changing some of these rules. We'll get to that later, but it's really not a big deal for us right now. There's still major support for this, but we'll talk about that news article that hit a couple of was that like 2 weeks ago?
Mhm.
It's not a big deal, but we're on top of that kind of stuff. So how do we do what's our investment strategy here? So what we do is we acquire the house, we renovate it, we permit it, build, and also during that permit process, we're also doing short-term rentals. And so we can get people in, get the higher return on the short-term rentals. But then also we don't have long-term tenants that we have to evict when we start doing construction. So it works out as a really nice kind of win-win. I'm just gonna mute everyone who's not talking just to make sure we don't have any background noises. There we go. Then we build the house, lease the house, and sell it. Just go as quick as we can with this whole thing. We can hold it. We're welcome to legally. We can hold it. It makes more sense to sell just because it just makes everything quicker, faster. All the turnaround times are faster. If we need to, we can sell. We can hold it, but in our strategy right now is to sell it right away.
Yeah. And experience. So again, I've been doing this for a couple of years now at this point with the ADUs. We originally, when we were doing this presentation, I'd done a project probably now 6, 7 years ago before all these ADU laws were implemented. And it made things incredibly, at the time, the city of San Diego made things very, very difficult. So I didn't do anything again for quite some time until they implemented these new incentives. So since then, this is one. We'll show in the next slide some more examples. But there's a project over in Claremont. It's on Fond du Lac Court is the name of the street, and it's a duplex, so a lot like similar to what we're doing on Tennyson, which is the project we're going to be talking about. It was originally a duplex, and we've added 8 units to it. So essentially, it's done now. We're now talking to our broker to see, the sale price and everything like that, and also our leasing agent to begin leasing. So these are the estimates of what we paid to build, to purchase rather, to do the rehab of the units, and then to do the construction and our results. So then about a 2-year time frame, 48% return overall. So we are now getting very, very good experience and good real world results of how these things are working in real time. And again, these are just some of the projects that different phases, again, from everywhere from we're now complete to in design phase as well. So we're getting just a lot of experience, and each time we iterate, we improve. And we're very vertically integrated. I'm a licensed general contractor. So we work to reduce our price as much as possible, reduce our timelines. One of the goals is, and we're getting ready to show their Bancroft project, which we've built in about 6 to 7 months. But our goal is to actually get, no matter what the size of the project is, to get it down to from foundation to when we start to dig the foundation to when the structure itself is completed to under 6 months.
Yeah, and we're also happy to tour any of these properties if you guys want to go see them. Gil's come out and seen a couple of these with us. Yeah. So here's a fun one. So this is like I mentioned at the top of the hour, the that drawing that we were looking at. Here it is in real life.
Yeah. Yeah, and again, this one we'd started construction right around the first week of September. I think it was right after Labor Day. And we're basically done. We're going to be installing appliances next week and doing landscape, hardscape, and getting STG&E to hook us up. Yeah. So that would all have happened within about 8 months, I believe it is. Andrew, does that sound right?
Yeah, we broke ground in August. So actually,
I think it's 8 months. Yeah.
Yeah, six. The whole thing, yeah, from breaking ground to a signed lease will be 8 months. Yeah. So our criteria, how are we finding these things? So I think we talked a little bit at the beginning is that we have our deal criteria, and I actually wrote a script that scrapes Redfin and Zillow and some other property management software platforms, and it pulls all this information in. So I pull all this every single property that's listed in the zip codes that we like. There's about 10 zip codes. Every single property that's listed, it actually gets scraped in based off of this criteria, and then it does an automatic underwriting, which is pretty exciting, pretty fun. But what we're doing is we're finding single family or duplexes, really good neighborhoods, Class A, Class B, and purchase price, about whatever, $500,000 to $2.5 million bucks, all in the city of San Diego, not the county, but the city. That's important because that's the rules. That's all the zoning laws that we follow. Generally multifamily, we're going towards now just because you can also do single family zoning too, but the city is thinking of getting rid of the single family, so we're just focusing on multifamily now. A lot has to be big enough to build stuff on, and we just we need to be in neighborhoods where it's more than $2,000 for a 1-bedroom unit, which is about half of San Diego. And then our model, we need to make it commercial, so we need to add 4 units. So going from one house to 5 or more, right? But more the better, more the merrier when it comes to this stuff. And like I mentioned, we do have an automated system where we have a whole bunch of crawlers and scrapers that go out. Brian, I think you might be, I don't know, you're I'm sure a much better automation engineer than I am, but it was pretty fun. Maybe I'll show you how I do it.
Yeah, would love to. I'm making some notes about some other ways to access real estate data. I've built some scripts over that as well. So I'll share some stuff with you later.
Sweet. All right.
Yeah, we also do reach out directly to we have a processes where some of it's either via cold calling or also via direct mail as well. And actually, the one we showed the video of, that one we'd acquired that directly from the seller, and so we were able to do a lease option agreement, which is really nice. We didn't have to carry any financing for 12 months while we did all of the design and permitting. So hopefully we'll be able to get more off-market properties as well as on market too.
Yeah. So we scrape it, find it either through automated scraping or through off-market marketing, or we do the initial review, build a detailed pro forma. We talk to land use lawyers and land use architects that specialize in ADUs, just to make sure we're very familiar with the rules, but we just want to have other people double check us, double check our underwriting, double check our zoning, double check the the requirements for different lots and stuff, and then we make an offer. So that builds us all up to this property that we are now in escrow on and we are raising for right now, which is a really awesome property I'm really excited about. It is 3754 and 56 because it is a duplex. Tennyson Street here in Point Loma. You can see the map here. So we have Pacific Beach over here. This is Point Loma, Ocean Beach, downtown, and Coronado Island, of course. The purchase price is $1.4 million. Right now, there's a 2-bedroom unit and a 1-bedroom unit. Rents in this neighborhood are $2,500 a month on average. And the nice thing is that when you look at those average rents, not only is that average, but that's also average age products too. And a lot of these neighborhoods are really old. I mean, these are 100, 150-year-old neighborhoods, right? Oh, wow. And so there's a lot of property. I mean, this property is from the 40s, right? So there's a lot of properties that are, $2,500 a month average, but that property was built in 1965 and hasn't been updated since, right? And this is not, when I say this neighborhood, I'm excluding anything that has a really nice oceanfront view or oceanfront access. So it's really just kind of like this center within a quarter mile, half a mile of this area. So not including any like luxury waterfront properties here in that number. And then this is also multifamily zoned. So there's no issues with us doing a big build here. This is intended to be multifamily. It's intended to have multiple units on it, and already has multiple units on it. So there's less restrictions on the on potentially any changes in the rules. So Tennyson, I didn't know. Marcelo, I don't know if you want to tell who Tennyson is.
Well, Lord Tennyson, he's an author from the 1700s. And in this area, they have streets that they call the author streets. So there's like Tennyson, Brown, Poe. So there's a bunch of streets, and they're alphabetical. These were all platted out in the 1920s, these streets, to show how old this neighborhood is, as to Andrew's point. So somebody, whoever the developer was, obviously liked literature.
Yeah. And his most famous quote is, "'Tis better to have loved and lost than to have never loved at all."
Yeah.
Right. But that's not a good quote, not relevant to us. So I picked a different one, which is, "Come, my friends, 'tis not too late to seek a new world." And this newer world for this project is to take this single family home and turn it into a 10-unit build, or 10 additional units, making 11 units total. This was a really quick render I got done in just a few days. So we'll have, this is just a 2-story render. We underwrote for a 2-story, but also we're really excited about is we can go 3 stories on this. So we'll be adding, oh, here we go. Here's a cool video. So here you can kind of see what the backyard looks like. I got a drone a few weeks ago, and I'm like really excited to use it, if you guys can't tell. So here's the backyard. Right now, there's this little unit. This is a permitted unit. This is a little office shed, and this all will be ripped out when we break ground. But in the meantime, we're going to be renting it on Airbnb just for cash flow.
Yeah. That's another nice flexible option, is to be able to do in this area to be able to do vacation rentals over the summertime while we're going through the permitting, the design and then the permitting process.
Yeah. So here it is. Here are the big numbers. And of course, I have a pretty extensive underwriting spreadsheet I'm happy to share with you guys. But the high level here is we purchased for 1.4 million. We're going to build 5 3-bedrooms and 5 1-bedroom units. Renovations and permitting will be about $180,000. Cost of build is 2.5 million, 2.6 million. Timeline, our goal is 18 months, but we're planning on 24 just to, hope for the best, but plan for the worst kind of thing here. At the end, we're expecting the rents to be 35,000 a month. And that's pretty conservative too, because that's actually, I mentioned before that average is $2,500 a month. This is underwriting these units at $2,200 a month. So more than 10% below average. And I think we can actually do better than average, but we want to be conservative in our projections. With that, we'll have an NOI based model. We're projecting our value after build to be just under 7 million. So 6.8, that's assuming no appreciation also. So San Diego appreciates on average 6% a year. And we're assuming 0 appreciation just to, just to be conservative.
Be conservative. We're conservative.
We have a preferred return of 8%, which means 100%. If anybody doesn't know what equity waterfall is, I'm happy to explain it. But the short of it is the first profits go to make sure everyone gets an 8% return on their money. So 100% of the profits go to the investors to get 8%. Once we get everyone 8% annualized, right? So if this takes 2 years, you get 16%. Then after that, the investors get 70% until everyone gets at least 18% return. I know it's percentages on percentages. It gets a little confusing, but we want to make sure that a majority of the profit goes to the investors before, we get them up to that 18% return before we start taking a lion's share. And after 18%, it's the opposite. The investors get 30% of the upside, and
that's the weakness of the project.
What's that, Gil?
I suggest you reconsider the split following the targeted 18%.
Okay, yeah, we can talk about that for sure. And then expected profits is 2 million on this, and so the annualized return on this is 25 to 35% on this, and that's annualized too. So that would be 50% to 70% over the 2 years. Marcelo, go ahead.
Yeah. So as we'd mentioned before, we're being conservative when we do our estimates, because I did live through the Great Recession and the housing and everything, what happened there. And so I feel there's a big part of this, which is, of course, the upside is great. More important than whatever money you might potentially make is to make sure that we don't lose money, right? I think it's Warren Buffett that said that the 2 most important rules are, number 1 is to don't lose money, and rule number 2 is refer back to rule number 1. So the things that we talk about, of course, market fluctuation, stuff that's completely out of our control. Right now we're in a world where how do I put this, getting more exciting with tariffs and wars and whatnot. So of course, we don't have a lot of control over that. Timeline, so things can happen. Obviously, delays for various reasons can come about. We work very, very hard to plan for longer timelines in our modeling than we actually plan for in our execution, and hoping that gives us enough of a buffer so that we cover potential downsides there. Cost overruns as well. I know one of the things is, I don't think Andrew mentioned it, but on underwriting, we have a third party actually do their own underwriting. And so that third party, they did it, and their pricing was higher than our budgeted pricing and higher than we actually ends up costing us. So we're adding, buffer on top of buffer in terms of that. And regulatory, of course, Andrew had mentioned, there is a little bit of shakiness happening right now where there's been some pushback in single family zones. So the good thing is that if you've submitted and you're already in the submission, and let's say 6 months from now, they decide to eliminate this bonus program in single family zones, if you've already submitted, then you're grandfathered in. We are also pushing now towards, as Andrew said, multifamily zones. So Tennyson, for example, is in a multifamily zone. So that's another way we're mitigating that potential regulatory risk in the future.
Marcelo, how do you know that they will grandfather this?
Because that's that's what they do. Once you've submitted, you're grandfathered in. That's the city's rules. So
they never go
get in
retroactive
before any changes. And that also happens with the code. Like at the end of the year, there's a wild scramble because every 2 years California updates the codes, and so does the city. So people scramble to get things in before the 2-year code shift. Because if you're in before, then you're covered. If you come in afterwards, you're not covered.
Cool.
Yeah, and ultimately, I mean, it takes us about 2 months to do the design engineering on the stuff, and then we submit. It can take less than that too if you're rushing it, but it takes us about 2 months to do that. And so once it's submitted, it's in. And then
just on that topic, I briefly read that article some weeks ago regarding the reconsideration. Did they request a report in 60 days over there?
They did. They requested a report in 60
just
days.
keep the timing.
They requested a report in 60 days for, and again, it was for single family zones. It was for development in single family zones.
Yep.
And again, as we'd said before, we do a very thorough analysis, greater market research, as well as when we go in to look at a specific investment, we go very, very, very local. We actually did make a little bit of an error on one, and we actually backed out. So we decided not to do it because we were looking at a property that was south of a particular freeway. We'd grab some properties that were north, realized, yeah, we don't want to do that. So we go very, very local in terms of our market research. So we literally go block by block to make sure that we understand what we're talking about. Cap rate assumptions are also, we don't go by what brokers tell us. We're always more conservative on the cap rate. That's important because, of course, a lot of your value is driven by the lower the denominator, the higher your overall number, right? So we keep them higher than we see even actual in the marketplace. Professional appraisals, third-party appraisals. As Andrew had said, we don't put any appreciation in there, although, I mean, we've seen historically San Diego has always appreciated. And we also build ourselves to, when the project's done, with all of those assumptions, that we're at roughly a 50% loan to value, so that if we do have to pull a loan and keep the property for some reason, that we're able to do that, qualify for the loan and cash flow. So we try and be very conservative. And also, again, with our construction, we do what's called a type VA construction. So everything we do is very much that wood frame construction that we're very familiar with. We have teams that we use over and over again, and they specialize in their specific areas where it makes sense. And then some of them will even take, like our framers, and they will actually do finish work, which isn't normally the case. So we've actually got our teams more optimized so that we can, over time, begin to continue to shrink our timelines. And of course, as any good builder does, buffering in for cost, buffering in for timelines. And we also use software to keep ourselves on track. So, yeah. And again, the regulatory stuff, we stay very, very close. Andrew has a friend of his who's actually a land use lawyer. So that helps.
Nice.
He has some folks on the inside, and that has helped us even specifically on another project we're doing, which is over in the coastal overlay zone. We were able to get some good answers on stuff like that. So
he's actually the head.
Very in tune with the regulatory situation. Mm-hmm.
He's actually the legal counsel for La Mesa City Council too. So, and doing ADUs and other property builds. So he's a good resource to have.
Yeah, and our folks in our team are very, very, they're all people who have people on the inside that they're able to pick up the phone and talk to.
Yeah, and so like we kind of said at the beginning here, but our exit strategy, and this is the last. I think we just have one or two more slides, and then we'll open up for Q&A. Our potential exit strategies here. The one we want to do, our plan A, 90%, 95% likelihood of happening is leasing it up and selling it immediately, and that's just really to kind of, that's just the quickest way of doing it. Make sure everyone gets their return quickly, just because it's,
the IRR is most effective, if you don't rent it out. Obviously, it's a huge difference, actually.
Exactly. If we need to, we can, just because I always say the person with the most options wins. So we need to have extra options. We can't just have one plan. So our plan B is just a refinancing and cash flow, and these will cash flow once it's done. And then also a plan C, just in case if there's any issue getting to the construction phase or anything like that. Having a property that has a permit on it, what they call a shovel-ready permit, is also really valuable. So we could actually just buy this. There's a whole business model of just buying a property. You don't even touch the property. You just buy it or lease it up or whatever, and you just get the permit. And then you can sell the building and the permit together. In fact, actually, if you look on Redfin, you can see there's a bunch of those properties on there actually right now. And the big thing in the last slide here, I think this is the last slide. Yeah, there you go. What makes us different? Well, we're experts in ADUs. We just think and breathe in the ADU space, and just in the city of San Diego, we don't have some Texas, some Arizona flips or wholesale of stuff in Wyoming or whatever that all sorts of everyone else does. This is all we do is the ADU stuff, and of course, our team is designed for ADUs. Marcelo's really good at executing, building these things and getting them done on time. Tech driven. I have my tech background. We have all sorts of different ways of doing automatic underwriting and pulling out the best deals and making sure that we're on top of this stuff. And then also co-investment. I didn't realize that this was a special thing until I started talking about other fundraisers, because apparently a lot of fundraisers don't put any of their money into the deal. That is not true for us. I almost have $1 million invested in our deals right now, and I put in $50,000 to $100,000 on every single deal, and Marcelo puts some in too. So, and also it's not just strangers. My dad's in the deal, my family's in the deal, some of my best friends are in the deals. So we are, heavy co-investment too with us. Yeah, and then the last thing here, call to action for you guys is you guys can sign up. Here's the property. Here's what it looks like on the Avestor platform. It is, I'll get you guys a direct link here in the chat. But if you guys are interested, go ahead and do a soft commit. Soft commit gives you, there's no legal obligation. It's just for us to kind of know what your interest level is in this. And we are asking a $50,000 minimum too. And we can go up to 150 on this deal. So I'm going to drop that in the chat. There you go. You just sign up like a regular sign up, email, password, and then you hit the soft commit, and it you'll know right away, and we get a notification of that too. That's it. Cool. Hey, Becky.
Hey.
And Billy and Bill, I think you guys all joined after the start of the hour. So good to see you guys. And Bill. So Becky, your question are so expected ROI. I can share my spreadsheet because of course I have a spreadsheet, right, Becky?
Of course you do. Of course you should.
Marcelo gets a little anxious when I share some of the returns because he's like, don't overpromise. Make sure we always underpromise and overdeliver. So we obviously can't promise anything because it is an equity investment. But here are our assumptions. This is what we're modeling. You guys can have this. So if you guys want to read through it, and play with it, you're welcome to. This is pro forma. There you go. And what we're looking at here is if we do a two-story build, which is more conservative, meaning it's raising less, exiting for less, a little bit easier, whatever. Probably, and also expecting shorter timeline, and no market growth, right? So just $24,000 a month in rent. No market growth, purchasing for 1.4 million, building for 2 million. Cost of capital is about $500,000 here. We're looking at return, LP return, limited partner investor return of 24% annualized for there. And then if we go a 3-story build, same kind of relatively conservative assumptions here, 0% market growth, going with 24 months just to be a little conservative, and we're looking at a 34% return. And of course, we can play with this model and see what happens if the cap rate changes. If it gets really conservative cap rate, this is like inner kind of East San Diego cap rates. Right now, this neighborhood's at like 4.25. You can play with those numbers there. If we have market growth, 10% over 2 years, it would go up a lot higher. But again, we don't want to be too we want to be conservative. We can also survive a drop too. If we have a 10% drop, we would still have really nice returns at a 10% drop. So we can survive. We would still be profitable even with a 14% drop in the market. So that would be a 2008. If 2008 happened, we would break even. We'd be able to return everyone's capital, but not return a percent, a growth on it. But if you go with that average growth over 2 years, it would be something like that. And again, we don't want to overpromise though. So we're saying we anticipate over 20%. And if you guys want to go over a spreadsheet, I'm always down to chat about spreadsheets. So thank you, Brian, Gil, Oliver, Pacey, Becky, Bill, and Billy, who was on earlier. So thank you, and we'll send out this recording too. And always happy to take a phone call and talk to you guys later.
Yeah. Thank you very much.
So we can share it to other people, hopefully to invest as well.
Perfect.
Yeah. Yep. Thank you. Appreciate it.
Thanks, everybody. Great to meet you, Marcelo.
Likewise.
Thanks.
Thank you.